Hello everyone and welcome back to the series where we cover the IGCSE Enterprise Syllabus step by step. If you haven't already, make sure to watch parts 1 through 5 because today we are going to cover Unit 6, Finance. This is a relatively long chapter, so it is divided into two parts. So let's begin. First, let's discuss the sources of finance. There are different ways to raise finance depending on the status of your business. First, let's look at the sources of finance for startup funding. So when starting a business, entrepreneurs need money and there are a few common sources. First is personal savings. Using personal savings means you keep full control of your enterprise, no interest is involved, and you have quick access to the money, but the risk is high and funds are usually limited. Family and friends. The finance is easy to get, flexible with no interest involved, but if the business fails, it can strain the relationships. Bank overdrafts, loans, and mortgages. If you don't know what these terms are, I highly encourage you to do a little research and get a brief idea of what these are. Anyways, these are great for large funds, they're repayable over time, but you'll face interest and debt obligations. Community sources. Like charities or social enterprises, they may support local businesses, but usually the funding is small and comes with requirements. Grants and subsidies. These are fantastic because they don't need to be repaid, but applications are competitive and restrictive. Crowdfunding. You raise the money from the public online, it gives exposure and validates your idea, but there is no guarantee of success and it requires a lot of promotion. Lastly, selling shares. You can raise a lot of money without repayment, but you give up ownership and may face pressure from shareholders. Coming back to this, now let's discuss the sources of finance for funding or continuing trade and expansion. Once the business is running, entrepreneurs often need more money to grow. Number 1 is personal savings. Again, the same pros and same cons. Number 2, retained profits. Profits reinvested back into the business, it keeps ownership intact but reduces cash available for other needs. Private institutions. They offer large funds and sometimes long-term support, but may require collateral or equity. Venture capital. Big money and guidance from investors, but they expect high returns and decision-making power. And lastly, issuing shares. This raises a lot of capital, no repayments required, but again, ownership is diluted and regulations increase. Now let's discuss the concept of trade credit. Another really common finance tool is trade credit. This is when a business buys goods or services now but pays later. Trade credit is the overall system of buy now, pay later, and the payment is usually delayed for 30, 60, or 90 days. Trade receivables is the money that customers owe you, and trade payables is the money you owe suppliers. So it makes a lot of sense because trade receivables means something you have to receive, so it is the money that customers owe you, and trade payables means what you have to pay, so money you owe to the suppliers. Anyways, that is the end of part 1 for Unit 6. Don't forget to turn your notification bells on so that you don't miss part 2. Thank you so much for watching. I hope this video helped.